All right, class, welcome. Today, we're going to jump right into a topic that is absolutely critical for your careers, the pension adjustment, or PA. Seriously, this is the thing that links company pensions to RRSPs, and you will need to know it inside and out to give your future clients solid advice.
Okay, let's get right to it.
So, to get our heads in the right space, let's start with a big picture question, a question of fairness. I want you to picture two people, okay? They earn the exact same salary, but one of them has a great pension plan at work, and the other one, well, they're on their own, trying to save for retirement in an RRSP. So how does the government make sure the playing field is level, that they both get a similar shot at tax-sheltered savings? That's the puzzle, and the pension adjustment is the solution.
Here's our game plan for today. We're going to start with the why, that whole fairness puzzle. Then we'll nail down what a PA actually is. After that, we'll roll up our sleeves and get into the math, starting with the easy stuff, contribution plans, and then working our way up to the trickier defined benefit formulas. And we'll wrap up by talking about what all this means for you as a future advisor.
You see, that whole puzzle, that question of fairness, it's all about balancing the scales. The tax system wants to help everyone save for retirement, but it has to stop people with company pensions from, double dipping on tax breaks compared to folks who are saving all by themselves.
And the main tool for this balancing act is the pension adjustment. The best way to think about it is as a measuring stick. It measures the value of the pension benefit you earned in a single year. Now, this isn't cash in your pocket. It's a calculated number that represents how much retirement savings were built up for you behind the scenes.
So, how does this number magically act as the great equalizer? Well, it's because it creates a direct link, a cause and effect relationship between your company pension and your personal RRSP room.
It's actually a pretty straightforward chain reaction when you think about it. Step 1, you work all year, you earn a pension benefit. Step 2, that benefit gets turned into a PA number that shows up on your T4 slip. And then step 3, that PA number from this year directly reduces how much new RRSP room you get for next year. It's a simple, elegant way to level the playing field.
All right, let's get our hands dirty with some numbers. We'll start with the most direct and, frankly, the easiest type of calculation, which is for contribution-based plans. Now, this slide here shows a really critical difference you have to understand. On the left, you've got defined contribution plans. The PA is simple here because it's just based on the cash that went into the account. The key thing is the employee bears all the investment risk. On the right, you have defined benefit plans, where the retirement income is a guarantee. So the risk is all on the employer, which makes calculating the PA a whole lot more complicated, as we're about to see.
Okay, so for a Deferred Profit Sharing Plan, or a DSP, it's literally just addition. You take what the employer put in this case $9 grand, and you add any forfeited amounts from other employees that got moved into their account. So $9,000 plus $110, bam! Your PA is $9,110. Simple as that.
And guess what? It's the exact same logic for a money purchase RPP. The PA is just the grand total of everything that went in. You take the employee's contribution, add the employer's contribution, and add any forfeited amounts. $2,000 plus $2,000 plus $100 gives us a pension adjustment of $4,100. See? It's just a sum of the inputs.
Okay, everybody take a deep breath. We're switching gears now, and this is where it gets interesting. With defined benefit plans, we're not just adding up contributions anymore. We are trying to put a present-day value on a future promise. It's a totally different ballgame. So the magic term you need to understand here is benefit earned. This isn't money sitting in an account. It's an abstract number. It represents the new slice of future, annual, for the rest of your life pension income that you earned this year. And we get that number by using the specific formula laid out in the pension plan itself.
So how does the CRA turn that future promise into a number for today? They use this very specific formula. You take that benefit earned, you multiply it by 9, that's a factor meant to estimate how much money you'd need today to pay for that future income stream, and then you subtract a flat $600. That little $600 discount is there just to make sure most people still have a little bit of RRSP room left over.
Let's walk through one. It's not as scary as it looks. In this plan, the formula is 40% of what the member contributes. So first, we find that benefit earned. The member put in $2,000, so 40% of that is $800. That $800 is the new amount of annual pension they've locked in for retirement. Then we just plug that number into our formula. So we take our $800 benefit, multiply by 9, and subtract 600. The result is a pension credit, or pension adjustment, of $6,600. And that is the number that will go on the T4 slip and reduce their RRSP room for next year. See how it all connects? That's the equalizer at work.
But just when you thought you had it all figured out, right? Well, there's another wrinkle. A lot of these defined benefit plans are built to work together with government benefits like CPP, and that adds another layer to the math. You're going to see this integration all the time in the real world. The idea is simple. The company doesn't want to pay you a huge pension on top of the pension you're already getting from the government. So the company plan is designed to just top up what CPP or QPP provides to avoid, over-pensioning someone.
One common way to do this is with a step-rated formula. It looks complicated, but it's not. The plan just applies a lower benefit rate to the part of your salary that's covered by CPP, that's the earnings up to the YMPE. Then it gives you a higher rate on the salary you earn above that limit. We just calculate the two pieces, add them up to get our total benefit earned, and then run it through that same PA formula we already know.
And the other popular method is the offset formula. This one starts by calculating a big gross pension benefit on your total salary. Then it subtracts an estimated amount for what you'll get from CPP. That gives you a net benefit, and that's the number we use to calculate the pension credit. And as you can see, the final PA can be quite different depending on which formula the plan uses. So, we've been deep in the weeds with the why and the how. We've gone through the theory, we've run the numbers. Let's zoom back out and focus on the most important part. What does all this mean for you as a future tax professional?
All right, let's pull all the threads together. Remember, at its heart, the PA is all about fairness. The first thing you always have to do is figure out the plan type. Is it based on contributions, or is it based on a future promise? That changes everything. And never forget that this PA number on the T4 slip isn't just some random detail. It is a massive piece of the puzzle for every single client's retirement plan.
And that leaves us with one last thing to think about as you move forward. Your real value as an advisor isn't just going to be about crunching these numbers correctly. It's going to be your ability to translate this stuff, to sit down with a client and explain in plain English why their RSP rooms suddenly dropped and how all these moving parts are working together to build them a secure retirement. Your real job is to bring clarity to all this complexity.